Well, it finally happened. The Wild West of crypto might officially be over. For what feels like a lifetime, investors and builders have been trying to navigate a thick fog of regulatory uncertainty. But that era just came to a very dramatic end. In a landmark move on March 17th, the SEC and the CFTC jointly dropped a new classification system that's going to change everything. So today we're going to break down this new regulation and explain exactly what it meant for you, your portfolio, and the future of digital finance. After years of regulation by enforcement approach that left the entire industry in limbo, the two most powerful financial regulators in the US have finally given us a clear set of rules. They released a 68-page document that established the first ever formal token taxonomy for crypto assets. SEC Chair Paul Atkins said the goal is to draw clear lines in clear terms, ending the years of confusion. This is a huge shift, moving away from lawsuits and toward clear guidelines. It signals a new, more collaborative chapter between Washington and the crypto world. So, what are these new rules? Well, the framework divides all digital assets into 5 distinct categories, and the big headline, most of them are now explicitly considered non-securities. First, and this is the big one, are digital commodities. The regulators officially named 16 major assets as commodities, including Bitcoin, Ether, and Solana. Also on the list are XRP, Cardano, Avalanche, and even Dogecoin. This is a massive confirmation that places them under the authority of the CFTC, not the SEC. These are assets whose value comes from the function of their decentralized network, not from a work of a central company. Next up, you have digital collectibles, which covers NFTs and certain meme coins, and digital tools, which are tokens used for things like access or membership. These are also not considered securities. The framework also covers stablecoins, noting that payment stablecoins that follow existing laws like the Genius Act are outside of the securities rule. And that leaves the fifth and final category, that is digital securities. This is for tokenized version of traditional assets like stocks and bonds and any crypto assets sold as part of an investment contract. The message is simple. A security is a security no matter what form it takes, whether it's analog, digital, or even crypto. Now, here's where things get really interesting. Even though an asset like Bitcoin is now defined as a commodity, it can still be treated as a security under one specific condition. That is how it's being sold. If an asset is offered to the public with the promise of profit based on an essential managerial efforts of others, it becomes an investment contract and falls under SEC rules. But the guidance delivers more game-changing news. It clarifies that this investment contract can end once a network becomes sufficiently decentralized. It also explicitly states that core network activities like protocol mining and staking are not securities transactions. This is a huge win for developers and validators everywhere, giving them the freedom to build and secure networks without constantly looking over their shoulder for the SEC's ruling. For investors, this is the moment of clarity we've all been waiting for. The uncertainty that has been hanging over major assets like Bitcoin, Ether, and Solana is pretty much gone. With their status as commodities confirmed, the door is now wide open for more institutional investment, deeper liquidity, and new products like more ETFs. The market has already reacted with a thumbs up, with reports of significant ETF inflows on the day of the announcement. Now, this doesn't mean that all risk has vanished. You still need to be careful with new projects that might be sold as investment contract. But for the established player in the crypto market, a huge chunk of regulatory risk has just been wiped off the board. This new framework is practically a green light for innovation in the United States. For years, many projects avoided launching in the US because the rules are so murky. Now there is a clear roadmap. Developers can build decentralized protocols and projects can use staking and mining with much more confidence. On top of the guidance, SEC Chair Paul Atkins also announced a proposal for a safe harbor for startups. This would give new projects a grace period, up to 4 years with a $5 million fundraising limit, to innovate and grow their networks without immediately facing the full weight of securities laws. The whole idea is to encourage builders to build in America. So, where do we go from here? Well, this joint interpretation is a massive step forward, but it's not set in stone just yet. The next big hurdle is obviously for Congress to pass the Clarity Act, which would write this new token taxonomy into law and make it permanent. But the direction is crystal clear. The era of chaos seems to be ending and the age of clarity has begun. This really is a turning point for the entire industry. So, what do you think about this landmark decision? Does this change how you're thinking about your investment? Let me know your take in the comments below. And if you want to stay on top of major news like this, make sure to subscribe and ring that notification bell. Stay safe, guys. Stay curious. And I'll see you next time.